Giddy up, team. Happy Monday. I typically don't make videos on Mondays because it's such a crazy day in our business, but this is pretty important stuff. And, you know, at the end of the day, may not be popular to talk about what we're looking at here right now. May not be good for business, but I got to show you the cards that we're being dealt here and got to tell you what I'm expecting to see happen. And I'm glad today that we're at least up a couple basis points here for the day on bonds, so we don't have to talk about the bond slaughter that is incoming with a big red candle. And so I'm not riding any wave on that front. We're just going to talk about what is happening with rates and when does that start to hit home values. Anecdotally, right off the bat, by the way, Derrick Evans, NMLS 155010. I'm a VA home loan specialist. We do all kinds of loans. We're a broker. You can call or text me if you want to buy, refi, shoot me an email. I'll answer your questions, help you make decisions. Here is what's happening right now. On the ground level, people are, reaching out to, they've been pre-approved. They're going, they're looking at homes, and then they're saying, hey, what is a payment on this one at this price? And they're getting the payment quote, and they're kind of going, wow, okay, that's a lot more. I guess, what do we need to be looking for to get our payment to this? So people are going out looking at homes, scrapping it because, they find out what they need to offer on the home to be competitive, and then they see what the payment is now with interest rates a little higher. And they're kind of going, okay, so we need to actually dial it down. We shouldn't be looking at 650. We should be looking at 550. So people are sort of already coming down the ladder, if you will, on, just activity. You're going to start to see that happen more and more. And so that's just understandable. When rates go up, that's what happens. The question is just the magnitude. We know rates are going higher. Rates are going up for sure this year. The question is how much and how fast. And that's where I don't have good answers. From the very beginning of this, we talked about how real estate values were not impregnable, but there was going to be very difficult to do anything against real estate values because of the fact that we have such a low inventory situation. We have crazy low inventory. We looked at the Altos research last time, 25% of the inventory that we had just 3 years ago. Way low. So even if buyer demand really comes down a lot, we still have so few homes for sale that you don't need a lot of demand for them to sell and to sell at market value. So the only thing that I've been tracking, the only thing I've been telling you, the only thing that could really put a dent in this whole party we got going on is if rates go up too much, too fast. Now, there is one silver lining element in this, and I want to get this out of the way before I start diving into some of these things here. If it's the case that rates do go up so much that it impedes people from buying, that will also keep a lot of people from selling. It's already difficult for people who are looking to sell, going, well, okay, I sell my home, sure, I made $400,000 cash, tax-free, cool. Now I'm going to go buy over here, but the prices are a lot higher and rates are higher than what I have on this one. So then they kind of look at it and go, well, wait a minute. Maybe we should just stay here. We have equity, we have a small loan amount, we have a small payment, we have a great rate. Why should we go mess around out there? So already it's causing a lot of people not to sell, which is compounding the problem. So if rates going up will actually cause even less people to sell. A lot of sell buyers just won't sell, which puts an even tighter squeeze on inventory, which makes it even more difficult for home values to go down as demand decreases. So I want to make sure we understand that point. That's an important point because I'm going to tell you some things here that aren't going to look good. They're not going to sound good. They're not good. And they are on our doorstep. But it doesn't mean that home values are going to crash or that the market is going to crash necessarily. There's a lot of things that would have to happen for that to be the case. But so far, unfortunately, those things are unfolding. So let's take a quick look here. This is mortgage bonds right now. Looking at the 3% Fannie Mae coupon. Just a quick analysis here. We unfortunately got outside of this range. I was hoping we would stay in this range right here. This would be a nice, comfortable range for us to be in. Yeah, rates are up, but hey, they're up, but they're stable. We broke through that. We're now below that, and pretty much I think we saw a small candle here today. You'll probably get another one, maybe a wick that'll stick through up here, and then most likely downward action. And remember, we want bond prices to go up. That means rates go down. When bond prices go down, that means rates are going up. And you can see when we zoom out, let's go back a year, bond prices have come down a lot. That's a lot of downward movement. So rates have gone up a lot. That's what we're seeing. That's what we're experiencing right now. Why is this the case? Why is this happening? Well, in an inflationary environment, bonds are a terrible investment. And right now, the suits are telling us, the government suits, not just the suits, but the government suits. Oh, shoot. Let me get myself out of the way. Sorry about that. The government suits are telling us that we're at 7% inflation. 7% is what they're telling us, which means, you know, for damn sure it's at least 7%. It's probably double or triple that, maybe quadruple. ECB came out and said 28%, and they held rates. So my guess is we're at least in the 15 to 20% range, but let's say 7. Let's just say that. Forget my conspiracy theory about what the real inflation rate is. You know what it is. You're paying for gas. You're paying for groceries. You know it's not 7%. Let's say it is. So now I'm going to buy a bond for 7% or for 3% return, right? Which is what this is. That's what we're looking at. Mortgage bond with 3% return. And I know that the money is eroding. That's what inflation is. It's the erosion of money. The rate at which your money erodes is 7%, which means I'm guaranteeing myself a loss of 4%. And I have risk that these bonds could go to zero. Remember, bonds are only good if the company's good. Now, these Fannie Mae bonds, they're not going to zero. There are probably very few bonds out there that would go to zero. The company has to go out of business, basically. Bonds get paid before stock. So bonds are safe, somewhat safe in that way, but there is some risk. So I've guaranteed loss of 4% on my capital, and I have risk. That is a terrible, terrible investment. What I've been telling you about what's likely to happen with bond prices is not just because of what I think, it's because of what Wall Street thinks. And I know how these people operate. And I know enough of them to know that when they smell blood in the streets, they are going to come for it. We have not even seen the beginning of the bond bully era. The bond bullies, which are the guys, imagine if Tony Soprano was a Wall Street trader. He'd probably be a bond bully. These are the people who will, when they see a company struggling, they'll go and they'll do lots of different things. Sometimes they'll buy all the bonds so that they have control to make certain things happen. Then they'll kill the stock. And then, you know, there's all sorts of crazy things that they do. But for sure, when they smell blood in the streets, which is exactly what we have with mortgage-backed securities, exactly what we have with the 10-year. We have it with a lot of different bond products right now. And by the way, the bond market is massive, in case you aren't sure about that. You don't realize why we're talking about bonds. Oh, bonds just like a little market. No, bonds is more than double the size of the stock market. As of 2021, the size of the bond market, 119 trillion. 119 trillion. Also, mind you, we'll talk about Bitcoin a little bit later. The whole entire crypto universe is less than 2 trillion. Bonds are 120 trillion. Okay? And right now, every single one of those bonds has a negative yield, a negative net yield and risk. That's $119 trillion that need to go somewhere. But meanwhile, as they're exiting bonds, here's the stock market. I've included these links so you can check them out. Stock market, about 49 trillion. So bond market, 119 trillion. So the money's got to go somewhere. Think it's going to go into stocks? Stocks pretty overvalued right now. S&P 500 still over 40 on the PE. That's correction territory. We've been seeing stocks struggling a little bit here. I've been predicting that that was going to be the case for some time. We'll see. We'll see how long it lasts and how bad it is. Today, markets are pretty flat. Pretty flat across the board. Not a whole lot going on there. Bitcoin's making a little bit of a run. We'll talk about that more here in a second. And oil on its way to a hundo. Remember, we predicted that. We said it was going to go at exactly 100, and we also predicted gold would not go anywhere, which is basically what it's doing. So bonds, however, you're going to see these in the green a lot. Rates going up. And the bond bullies are going to come in because the Federal Reserve is such a big beast. Right now, they are the one who are buying a lot of these bonds. The free market doesn't want them and shouldn't want them. The Federal Reserve, the whole purpose of taper is to stop buying bonds. but to do it slowly, to pull the rug out from underneath the bond market as slow as possible. However, because they're doing it that way, what they're doing is they're giving the bond bullies a target. They're telling them what their moves are going to be, and they know they're just waiting in the cut. I don't think we've seen them show up too much yet, but they will come in. And once the Federal Reserve is weak enough with their buying power or weak enough with their stance or just as much out of the way as they need, they're going to destroy the bond market. Wall Street, greed is something that you can count on. You can set your watch to it. It is coming. And they are going to, and this is just a strategy. Dave Roche's, he's a smart guy, someone that you can say, will shoot you straight for the most part. He's saying, hey, all of these bonds are worthless. Short everything. He's not the only one who thinks that. A lot of people do, including the bond bullies, and they're going to come for those bonds, which means that rates, which have already gone up probably 1% in the last 6 weeks across the board, or right around there, they're going to go up sharply as this takes place. And this is going to be, my guess is this is going to happen throughout this year. So with bonds being attacked and their protector, so the protector, the big brother for these bonds has been the Federal Reserve. The Federal Reserve has come in and been buying these things. Mind you that when we zoomed out on this chart, let me zoom out again. I forgot to make an important point. This decline that has taken place in the past year, where does that begin? Less than a year. Let's call it, since what, October? That's fair. Let's say August. Let's go to the top, the most recent cycle high. From August to today, this is all with the Federal Reserve buying these bonds. So we've lost, 400 basis points with the Fed having our back. The Fed is going bye-bye, which means these bonds are going to be under extreme selling pressure, and that means rates are going to spike pretty high. How high? Derrick, how high? How high could rates go? They can't. They certainly won't allow that to happen, will they? You sure? Are you sure? You sure they won't let that happen? You think the Federal Reserve will just come in and just save the day? They might, but they can't move that quickly, and they've already told the market what they're going to do. It's possible they could come back in and buy, but that would just make the problem so much worse if they did. It's already really bad. If you see these articles that talk about how the Fed is between a rock and a hard place, or behind how they back themselves into a corner, it's because they can no longer provide stimulus. It has gotten out of control. Inflation is rampant. It's hyperinflation. As I told you a year ago, it was hyperinflation. And now we know for sure that it is. So we have hyperinflation. You can't do anything inflationary anymore. You guys have got to raise rates. You've got to stop buying bonds. You've got to stop propping up markets. You have got to get the F out of the way. You have to. You have to let it fall now so that we can find normal again. And that's that is what is underway currently. So how quickly and how bad will it be? Well, we're already at a point now where we're really getting close to the 4s for conventional loans, still in the low 3s for VA and FHA. And so rates are still in a pretty decent spot. This could be very well the last time. If I guess I'm going to give a shout out here, put my contact info up. Could be one of the last times to get a really decent rate for years to come. And could rates go to 5% this year? 100% they could. Could rates get to 6% this year? Yeah, that's on the table. That is on the table. I mean, think about it. If inflation is coming out at, and by the way, we're going to get inflation on Thursday, I think, this week. Inflation number, CPI. We'll see how bad that looks. That's going to move things for sure. I suggest locking rates, especially on a day like today. Hey, look, we're up 9 basis points. Look at that. We got a little scary there at the end of the day. I like it. Lock this. Lock that. Basically in a situation where it's just lock it. As soon as you see it, lock it. If we get some sort of rally, if a miracle happens, and it's possible, right? It could happen. If we get a miracle, let's say the inflation numbers come out and it's tame, and the Fed goes, you know what, guys, we're going to put a pause on everything we talked about. We're not changing anything. Inflation has tamed itself, and all is good. Then yeah, bonds would spike up because all these guys who are shorting the bond market right now are setting up short positions, and that's what they're doing right now. They're setting up short positions. I can promise you that. They're getting short, and they're cost averaging in, and then they're going to dump huge market sell orders on this thing as soon as they know that it's weak and it's getting close to that time. But it also could bounce back. This whole process may not last that long. It could be a month or two. It could be 6 months. It could be a year, and we don't know. But I don't think it'll last too long because it'll be overdone, and then it will correct. If it's overdone high side, it'll be overdone to the low side. It will correct. We will find stability. But there's some bumpy times ahead. So this is why I've been locking every rate that I can as soon as possible, because we don't know when this day is coming or when these days are coming, but we know that rates are going to get hit. There's no way around it. The only catalyst that we have higher is a big one, be the Fed changing course, but that also is quite unlikely. So when will this affect home values? If it's the case that higher rates are going to cause even less people to sell their homes when we already have an inventory shortage, doesn't it seem like home values would still hold? And I think they probably will. They probably will for the most part. Maybe you'll see a little softening in a couple places, like, first-time buyer level. There's going to be certain pockets in the market, like the $800,000 detached house that just a year or two ago was $600,000. That one might struggle. That one might struggle. There's going to be certain pockets of the market that work really well, certain ones that don't. All of the entry-level stuff, the condos, the lower-price stuff, there's still going to be tons of attention on that. In fact, there's going to be more attention on those homes now because you're going to have people who were looking at $550 before now coming down to $500 or $450 because rates have gone up. So you're going to have a lot of attention on the lower price point stuff. I think the higher price point stuff is going to struggle a little bit. Higher price point conventional stuff is going to struggle a little bit. But there are a lot of segments of the market that will be okay, with this. It's just a matter of, will the consumer, will the home buyer feel okay about shelling out what it takes to own the home or not? And we know home buyers are already kind of over it. So if we add this into the equation, will that make them scatter like roaches? It could. It could just scatter all directions. But I don't think so. I don't think that's going to be the case. I think we'll have enough demand for the lack of inventory that we have to hold home values steady, but it will be held on the backs of new buyers having to foot the bill and foot that higher bill. Now, what it does is it sets up, if we have a scenario like that goes on for 6 months to 12 months, it sets up a really nice opportunity for a little refi boom to take place the following year. So if we get that happening this year and then rates stabilize, normalize maybe next year, then you could see a little refi boom next year. And so that's one thing I want buyers to keep in mind. If you have to take a higher rate, the higher the rate you have to take, just know the greater the chances are you'll be able to refinance down the road. If you have to take a 4.5% to buy a home because you're getting a conventional loan and your credit score is 650, you very well may be able to refinance that in the future for something in the threes, and it'll make sense. It'll save you money. So just keep that in mind. If rates get to 5%, rates get to 6%. Oh my gosh, what a crazy thing to say out loud, huh? If that were to be the case, it just increases the chances you'll be able to refinance later. Because most likely, whatever spike we have here in rates, it's not going to be a permanent thing. It's just the opposite reaction of pulling the rubber band. So the Fed, in doing their stimulus, has pulled the rubber band to one side, and now it's just going to come back. So it's like a clock swinging, the pendulum. It swings too far one way. They've pushed it really, really far this way. The Fed has gone, they've pushed that pendulum really, really far this way, and now it's going to swing back. And when it swings back, we get that ebb and flow. So I expect that we'll see it spike. It'll get bad, and then when the bond bullies exit, they're mega short. You'll see there will be bond rallies. Rates will drop. We'll probably have a refi boom. So that is my guess of what we're going to see in the next couple of years here. And I think we'll look back on rates where they are today. A lot of people are saying, oh, rates went up. Oh, rates are high. And we'll be like, wow, those rates were amazing. I'd kill for a 3.875 conventional loan, or 3.75, which seems to be the rate we keep quoting on conventional purchases. A lot of 3.75 quotes for conventional. We'll look back on that and go, 3.75 is so low. That's my guess. So I am live. If you got questions, you want to chat, you want to say what's up, feel free to jump on there. I'm going to cover a couple more things, and then I'm going to swing back to this. So here's one more thing. And this was sort of the Jeff Cox is pretty good over here at CNBC. He's actually pretty good. He said, rapidly rising wages are expected to push Federal Reserve interest rate hikes at an even faster pace. So the inflation that's taking place is causing companies to have to increase the amount that they're paying people. And guess what happens when big companies, gosh, I'm so bad at this. I'm not a very good producer. Get myself out of here. So companies are having to pay money. What happens when big companies have to start shelling out extra money? You get political pressure, right? They're like, hey guys, fix this. Why do we have to keep paying people so much more? This is ridiculous. It's inflation. It's what it is. Yeah, there's people who are supposed to fix that. They're called the Federal Reserve. They've been sitting on their hands for too long. If they took action a year ago, when I was saying that they should have, the market was super hot. They would have easily been able to absorb it. They could have got it done and out of the way. Now, unfortunately, they've waited too long. Now, different markets are softening. Different people are noticing things, taking action based on current market conditions, and it's too late. Now they're just going to put fuel on the fire, unfortunately. So 7 hikes? Whoa, what? I thought they only said 3. Didn't the Federal Reserve only say 3? And then some people were prognosticating it could be 4. The worst case scenario negative Nancy guys were saying 5. 7? Fast rising wages could cause the Fed to raise interest rates even higher. Wow. So that's the other thing, is that now them raising interest rates is deflationary. It's actually good for bonds. It's good for bonds. But unfortunately, the reality of this needing to be done just confirms how bad inflation is, which is bad for bonds. So we won't see the benefits of their actions on that side of it for quite some time, unfortunately. So even if the Fed is out there raising interest rates, it isn't going to help the bond market right away. It's going to take some time for that to sort of spill over and become positive. And that's one thing to keep in mind. Definitely read this article about David O'Shea talking about shorting the whole lot of them. He means every single bond that's out there. This one was interesting, how Wall Street learned to love Bitcoin. It's kind of it's a cool video that this guy made that I think is interesting to watch if you're into Bitcoin. We're going to look at the Bitcoin chart in a second. This is an important development. Ted Cruz discloses a Bitcoin purchase for up to $50,000. Why it's important isn't because of the amount that he purchased. This is probably a token purchase. Hey, guy just saying, hey, listen, I'm going to buy 1 Bitcoin because I want to show people that I'm pro-Bitcoin. So I need to own Bitcoin. I can't just say I'm pro-Bitcoin. I need to own it. It's a smart political move. What you're starting to see, though, and the reason why I want to post this is because you realize when politicians do stuff like this, we heard today KPMG, which is like the biggest, or it's one of the top 3 accounting firms in all of the world, has bought both Bitcoin and Ethereum on their balance sheet. Let me repeat that. KPMG. That's right. Phil Mickelson guy. His hat always say KPMG on it. One of the largest accounting firms in the world has disclosed that as of the 4th quarter last year, they have purchased and are purchasing Bitcoin and Ethereum for their own balance sheet, an accounting firm, a huge one. So what you're starting to see is politicians are noticing that it's actually beneficial for them to say that they're behind cryptocurrency. It's beneficial for them to say that they own cryptocurrency. It's gaining constituents for them. It's making the people who support them happy. And that is how things are supposed to get done in the system that we have. People are supposed to represent the interests of the people. Politicians are supposed to represent the interests of the people. So this is a token purchase. I don't know if Senator Ted Cruz even knows what Bitcoin is or how it really works, but he bought some. And he did it because he knew he'd get this press. And Texas is trying to fast track their way to become the Bitcoin haven of the world. And if they are successful at this, I mean, they're bringing miners there. They're providing all kinds of tax benefits. Texas will become even more of a rich state than it already is. All right. Quickly look at the chart here, and then I'm going to recap shortly thereafter. So this was, we were charting this. We had the intermediate downtrend, the mega macro uptrend for Bitcoin. When were we going to see something break? Well, the downtrend broke. So now we can get rid of this line here. This is no longer in play. It broke over the weekend, and prices went significantly higher. We're in from the high 30,000s now to the low 40,000s. And this is what I expected to happen. This is what it looked like was going to happen, but you never know. The financial markets, you never know. And so Bitcoin now testing some different resistance levels from back here, but moving higher. The supply shock scenario that we are seeing in real estate is built into the code for Bitcoin. So people ask me why I'm so bullish about it, because it's literally programmed to go higher. It's programmed that way. That's how it was built. It was programmed to be a deflationary asset to help your money grow over time. And we are still, well, just as a real big zoom out here, that's the channel that we're in. These are exactly parallel lines here. And that's the channel, and it's moving higher. So there's different elements of the channel, but as you can see, things are going up. I do think that the future is bright for Bitcoin. I do think there's going to be volatility. I do think some people are going to make mistakes and lose money. The best way, in my opinion, to invest in is the way that I've done it, which is to dollar cost average by buying small amounts every week over long periods of time and plan on never selling. Or in my case, won't consider selling, can't consider selling based on my investment thesis that I created for this and my investment plan until the Bitcoins are worth at least $400,000 a coin, or it is January of 2025. So I'm on my hands until at least then. And that's just how it's going to be. What's up, JCK? You're welcome, my friend. I appreciate you checking it out. Hopefully it's helpful. And hopefully everybody realizes what I mean by this. And you don't take this to be super bearish, particularly for real estate, but it's definitely bearish for like loan officers. So I apologize to my loan officer friends out there. We have a tough market ahead of us here. Refinance is going to be pretty much gone. There's going to be actual duels and sword fights for purchase deals that are already taking place right now. And it's just going to be a very difficult market for us. Just put it that way. It's not going to be easy. You're going to do a lot of work, make a lot less money. So get yourselves ready for that. From a real estate perspective, people keep asking about a crash. You can't have a crash without inventory. And rates going up actually, I think, helps pinch inventory even further. So I think the probability for a crash actually decreases quite a bit if rates go up a lot. What would cause a crash would really be just a huge influx of inventory. And I haven't figured out how that could even happen at this point, unless like a BlackRock or someone who has a huge portfolio of real estate decided to start selling it. And I do not think that's why they have purchased real estate in the first place. They purchased it for income as bond replacement. Remember when I was talking about that? Bond replacement? Why was I talking about bond replacement? Because there's a $120 trillion worldwide bond market that's garbage. It's garbage. All of it. Short the whole lot of them. They're all worthless. So, not worthless, but they're not good investments. They're not good investments. Just using simple math. So if there's that big of a market that needs replacing, where's all that money going to go? A lot of it's going into the real estate market, bond replacement. I think a lot of it has gone into the stock market, growth replacement. I think a lot of it's going to go into the crypto market, speculative replacement, right? There's not a lot of bond money that goes into crypto, right? Oh, wait a minute. They're making a Bitcoin bond? Yes. El Salvador has created a Bitcoin bond, and it's being released this month. We're going to see what demand looks like, but I'll bet you the demand's going to be through the roof. It's one of the safer bets you can make in a bond scenario. I'm not going to take the time to explain it right now, but basically El Salvador is able to create Bitcoin from the energy that they have. So they're an energy-rich country, and they're able to take that energy and turn it into Bitcoin at a very inexpensive cost. So the higher Bitcoin goes, the higher these things go. So they issue bonds to do this activity, to finance this activity, which is pretty much guaranteed to print money. And so because they're making the power, they're turning power into money. That's what Bitcoin miners do. You essentially take power and you turn it into capital in the form of Bitcoin. So especially as Bitcoin goes up in value over time, these bonds have zero risk, essentially, both to the issuer and the purchaser. There's just so much cool stuff going on with that. I think you're going to see other countries, companies, miners are going to start doing this. And you're going to see a bunch of this $120 trillion bond market that's all garbage bonds move into things that make a little bit more sense for the new era. Bonds were a great investment for a long time. Interest rates were higher. People would invest in bonds and get 6 or 7%. My grandparents, would probably invested in something like that. We have a new world in front of us now. And unfortunately, we might get caught in some of the friendly fire of the transformation of this bond market. Being in the mortgage industry, we might be part of that. But I can almost guarantee you in 10 years that mortgages and many financial products, particularly loan products, will be done through cryptocurrency or crowdfunding type scenarios. I can almost guarantee that. It's so much more efficient, so much more transparent, and you don't have to sit around and wait for some old guy named Jerome Powell to come speak and sit there and wait on the edge of your seat. What's he going to say? Is he going to crush my portfolio? You don't have to do that in the new world. So that's all unraveling. So, all right, I'm going to get back to making phone calls. You guys have a great day. I appreciate your time. If you want to buy, you want to refi, or you know someone who does, have them give me a call. Shoot me a text. Send me an email. I'm happy to help. Hopefully this helps you in your business, and I'll see you guys soon.